Hello, this is Dustin with Dustin's Dollars. Today I am going to be talking again about Tellurian stock, and specifically about Tellurian's phase one of Driftwood LNG and what the cash flows could look like from that. This is all going to be a hypothetical discussion because there's a lot of unknowns, but I'm going to try to make sort of share my current model on how I'm looking at it. Before I begin, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Tellurian stock, so basically this video should be for your entertainment purposes only, because I could be wrong about everything that I say in this video. You need to do your own research before making any investment decisions. So, we're going to be talking about Driftwood LNG Phase 1. Again, this is Tellurian stock. And this is from what I'm presenting right here, this is from their most recent corporate presentation. I'll try to make that a little larger so you can see. These are the numbers that they give for the overall financing of phase one. So they have the costs laid out here in terms of how much it costs to actually, the cost to build the terminal. Also have this owner's cost. You have the cost for the pipeline, and then the financing and the other costs are going to go along with that during that time. And so they say the total development costs for the Driftwood LNG terminal phase one will be, according to these estimates, $11.9 billion. These are in billions with a B. And so what I did for this portion is I copied these over into a spreadsheet. So we got our 11.9 billion here. And I'm actually going to add 15% across the board for all of these due to inflation. And because these numbers, I think you see, if we go all the way to the very last slide, I believe it is in this presentation, they like to highlight the price refresh in April of 2019 resulted in roughly a 2% increase after 24 months, right? So they've actually had the plans, and in fact, they've had the plans for Driftwood LNG and the contract with Bechtel for them to construct the Driftwood LNG terminal for many years, for 5 years or so, I think, somewhere in that vicinity. And so they actually did a price refresh in 2019. That's where they got that 2% increase. And I don't know that they have more up-to-date numbers as of today. I can only imagine, given how things have been in the past year or two, that some of the costs have gone up substantially. And so I'm using a number that again, I have no concrete basis for using 15%, but I am plugging in a number here just to account for the fact that these prices that they have in their most recent presentation, despite the presentation being from, I think, November of 2020, are probably not credible for today's environment anymore. So that is the overall financing cost that I'm going to be using. This the overall cost for Driftwood LNG is this $13.8 billion. So what does that look like? They also give some guidance on how that's going to be funded over the course of time. They say that this is going to be funded from 60 to 70% with debt. That was their prior goal, or at least what their target, let's say, that was included in this investor presentation. And they show how year over year this is a constant contribution from the debt, and Tellurian also kicks in a good chunk here, right? This, I think, would be representing 60% equity, right? That's 1.2 billion from the bank and 0.8 billion each year from Tellurian itself. And one thing that they do call out here is that near the end of the construction of phase one, they expect to start producing some LNG before the complete end of the project. And so they will actually be able to have some free cash flow that can account for that they can actually send to as the payments for the rest of the project, instead of having to, let's say, issue equity in order to get those funds near the end of the project. So that is one thing to keep in mind. And again, this is illustrative for a 60% debt financing. They could have higher debt financing, right? They do say 60 to 70%, and I'll give a little bit of opinion on that later on. But so that gives you some idea here, and I modeled that out here. This top scenario is showing 60% debt, and so we have years 1 through year 6. Let me maybe zoom in a little bit to make these numbers even a little bigger for you. So we can zoom in here, and we see every year with my increased numbers by 15%, TEL will be contributing about $900 million each year. They would have about $1.4 billion of debt each year in terms of contribution to the project. And then they would get some free cash flows. I did also scale these up just slightly and sort of put in numbers. They didn't give an actual distribution here, but they do sort of imply that there's a little bit of cash flows in year 5 and more cash flows in year 6. So I put in numbers here of 0.1 and then 0.8, just as $1 billion per year, just in terms of to sort of try to estimate what that would look like. So if we run the numbers there, that means that TEL would overall be contributing $5.4 billion, and they would be taking on $8.4 billion of debt. And this is, again, the 60% debt scenario. And so overall, that means that, because they have some free cash flows here to offset what they have to contribute, in the end, they would need to issue equity or somehow otherwise, come up with $4.5 billion in order to fund their portion of Driftwood. Now, if we look at the 70% equity scenario, and this is not exact, or this is actually 71%, almost 72% here, but this is in order to keep the numbers roughly even as I'm looking at them here. I modeled this out, and this would have Tellurian contributing significantly less. They're contributing only about $650 million per year, and debt contribution each year of about $1.65 billion. And so in total, that would mean that they'd take on $9.9 billion of debt, and that Tellurian would contribute $3.9 billion. If they also were able to get free cash flows from LNG production of 0.1 and then $0.65 billion in those last 2 years of the 6-year construction timeline, then that would mean that Tellurian would need to make up the difference there, which would be $3.15 billion, presumably through some sort of equity. And what I did then is I took that, and I also am using their overall model of cash flows, and this is at $14 JKM, which I think I'm going to use those numbers as well. I think that's a fair estimate given the current. You can have your own opinions on what the price is going to be. I think that's a fair estimate given that the current prices are roughly double that. The prices in years in like 2026, right, a couple years in the future when Driftwood might actually start producing, the prices are lower than that, but they sort of the prices of JKM LNG seem to go up as the time until the delivery of those futures gets shorter and shorter, meaning as of right now, the price for LNG in 2026, the futures contracts for 2026 are lower than $14 JKM. However, I think as it gets closer and closer to 2026, you'll see that those prices might get pushed up as people actually need the gas, and it's not just far off in the future speculation that people will be buying right now if they're buying those futures. So, because that is actually, sorry, and I should go here. Great, it has to reload. Give me just a moment here. You'll see this in terms of the contracts for. Clearly, you see it in the contracts we have today, which that's a big surprise, I think, for folks. Or not a big surprise for folks because, Europe is now importing LNG because of the conflict with Russia and the gas that is not flowing from Russia anymore. But even if you look out, let's say, to load this, let's say winter, we're looking at December of 2023, right? So that's more than a year and a half in the future from today. If this chart will actually load. Sometimes I have issues with these loading. Hopefully it will load. One moment here. Yeah, there we go. So if we look here where you can actually see, you can see that as time, this is the futures for December 2023 of JKM LNG. And so you can see that as of April, May, February, right, these prices were much lower, and it's gone up and up and up as time has gotten closer. I mean, and granted, this is also just overall energy prices have gone up. Some of this back here, you would probably still have some of those effects of COVID, but it's an effect that we have seen. And I think, if you look through Tellurian's maybe I'll make a video on this. But if you look through the rest of their investor presentation, you even look at some other reports from the government, from other industry groups, it does seem like there's a growing demand for LNG and not the same amount of supply that is, currently planned to match that demand. So it's not unreasonable to think the prices would be at least what they are, or roughly what they are today, or let's say maybe a more moderate version of what they are today, given that prices today are kind of inflated from Russia. So getting back to the meat of today's video, I am using that $14 JKM minus $2 per MMBTU for transportation, which is the same numbers that they used here. So you take that $12 per MMBTU. They think that they can source it if they have to purchase it off of the market for $4 per MMBTU. It's going to cost them about $1 to liquefy it and transport it to the actual coast and get onto the ship that takes it to whichever whatever client is actually taking the LNG. That gives them a margin per MMBTU of about $7. Multiply that by their 550 BCF per year, and you are looking at about $4 billion in annual cash flows. So I loaded those numbers into my spreadsheet here, and you have the same cash flows here. They also have a model, I'll call this out, where if they are able to produce the gas upstream, their cost structure basically just knocks $2 per MMBTU off of their gas sourcing costs, where instead of having to purchase it for $4 per MMBTU, they think that they can produce it for $2 per MMBTU. And they have, I think, been able to do this. I haven't dug into the numbers myself, so I'll give the caveat there that I haven't done my due diligence, but I trust management. They have operating gas production right now, and if they think that they can do it for $2 per MMBTU, that seems, I have no reason not to believe them. However, they don't currently have the gas reserves to come close to supplying this terminal, to supplying all the LNG that they are going to produce here. So, in order for them to actually do this, they would have to acquire some more acreage, acquire another company, something. They're going to have to do something. They're going to have to make a whole other deal if they want to be able to actually just get the gas at $2 per MMBTU. So I'm going to mostly be using this $4 per MMBTU in terms of upstream gas costs, with a caveat there, and that is that I think if they produce more, they could actually hedge a little bit. And this is something that they talked about, is having a physical hedge for their cost of their gas sourcing, where they say, hey, if we have at least some producing wells, we can offset a little bit. If gas sourcing costs, for some period of time actually get very high, we can ramp up production, or even just on a normal basis, they can actually hedge that price a little bit. Right now I have this model here where if they're 10% hedged, right, you sort of do this weighted average where you have 10% of the gas coming from their upstream production and the rest of it coming from the market, and you get an average cost there of $3.8 per MMBTU. So if we use these cash flows that they have here in terms of just multiplying out the margin by their the capacity of Driftwood LNG, and then we come down here and we sort of join that together with the funding models that we had for their 70% or 60% debt scenarios, and we look at how much equity that they would actually have to issue if they were going to do this, to close these gaps of, in the 60% situation, they needed $4.5 billion. In the 70% debt situation, they need about $3.15 billion. And for this purposes, I am assuming that they issue that no matter what the actual structure of the deal, it's all going to come down to how many shares of dilution is it going to cause, right? Even if they do some sort of, Class B shares or special preferred shares, in the end, almost all of those deals end up converting into common shares, or have basically they increase the fully diluted share count of the company. And so, forgetting about the actual structure, if the impact of whatever deal they make is diluting at roughly $4 per share, that is my current assumption, right? Tellurian is trading right now at it closed today at 411, and I think it's been, you look over the past month, it's been roughly around that time, or roughly around that amount. So if you figure they can issue at about $4 per share, and I think that's maybe pessimistic, because if they are looking like they're very, very likely to hit to actually get financed and to get to declare a positive final investment decision and go forward with phase one, I think this stock is going to be worth a good chunk more. And when you look back and you say, hey, they actually have to contribute this money each year over a course of years, by the time they make a final investment decision, TEL stock would be worth actually a lot more. So we'll see, but I'm trying to build what I think is a fairly conservative model. And so if we assume that they dilute at $4 per share in order to make up their portion of the contribution here to fund Driftwood in a 70% debt situation, they would need to issue 787 million shares at $4 per share to make up that, what did I say? I don't have it written down here, that $3.15 billion. And in the 60% debt scenario, they'd have to issue about 1.125 billion shares at $4 per share in order to make up their portion of it. So getting to the point of all of this. So if they issue all of those shares, what do their cash flows look like if we take this amount in terms of billions of dollars of cash flow, and then we shouldn't call this free cash flow. This is free cash flow excluding their sort of their OPEX. So this isn't the model's not completely there, but if we look at this, so this is maybe be an upper bound on what you could expect, but I actually think their OPEX is fairly small compared to this. It's hard to predict. I don't know how to predict what their OPEX would be at this point for Tellurian. So that's something to keep in mind. Maybe, you maybe knock a 30% off of this. Yeah, again, that's an arbitrary number, and maybe I'll do some studies in the future and try to project out what that would look like. I'd probably try to look at Cheniere as a model to look at and see what does their OPEX look like. But the cash flows per share, even with this amount of dilution, would equal in this, if they were purchasing gas off the market at the $14 JKM, meaning at $12 after you subtract off the $2 for transportation, of $2.04 per share. And that's in the 70% debt scenario. And if you're looking at the 60% debt scenario, that's a little lower. It's $1.73 per share. And I think I mentioned it, but this is actually after my estimated interest payments that they have to pay on the debt. This is assuming a 12% interest rate on those whatever amount of debt that they borrow. And so I have that here in this row that's subtracted off before we get to this sort of overall free cash flow in terms of billions of dollars. So the point here is in a couple of these scenarios in the let me drag this down so we can see them all at the same time. In the market gas scenario, they're paying more upstream, and so the cash flows are slightly lower. And we're looking at $2 or $1.73 per share, sort of an upper bound of cash flow. You can subtract off their OPEX. It's sort of hard to estimate, again, what that would be. It's also hard to estimate or to figure out if there's going to be some additional fees that the Driftwood project pays to Tellurian to offset a little bit of, some of those, let's say, services that Tellurian provides. So it's hard to say exactly what this would look like. We'll see. I guess maybe that's not relevant in their current financing model. So scratch that. Never mind. Maybe I shouldn't do these videos live, make mistakes. So anyways, I also have this model here where they hedge. And I say, hey, maybe if they can hedge 10%. And that's, I think right now their proved gas reserves are about 6% of the gas that they'll need over the 10-year time frame of their current sales and purchase agreements. Figure if they are able to, eke out a little bit more gas. Maybe that's not a little bit more. Maybe that's unrealistic. I don't know that much about oil and gas, the actual specifics there and what it means to have proved reserves. But I know that they have a lot of acreage, and if they were able to get to be 10% hedged, that would bring the cash flows to about $2.12 per share or $1.80 per share at that point. Now, if we assume a higher JKM price, even $2 higher, that comes just straight off the top, right? Because Tellurian's contracts that they have are roughly based off of JKM prices. I think it's JKM and TTF, and not all the contracts are exactly the same, but they're going to sell that at those prices that are indexed to the overall LNG index. And so if the prices are higher, they're going to make more revenue. None of their costs get higher. Excuse me. And I mean, maybe their gas sourcing costs would go up. Ooh, why is that so low? That's not right. Sorry, that's a copy paste error. Let me just put in $4 here. There's no reason to get fancy here. So if they were buying gas for $4, but they were able to get JKM was at 16 to subtract off $2 for transportation, so $14 in terms of their actual incoming revenue for the JKM or for the LNG that they sell at the Gulf Coast. That translates into roughly the same economics as the upstream production, and that gets you to $288 per share of cash flow in the 70% debt scenario and $240 in the 60% debt scenario. Now, these numbers are pretty interesting when you look at the current share price of $4, and change. So if you think, hey, in 5 years, 6 years, this company could be producing cash flows of roughly $2 per share. Even this is, again, including the dilution built in of them issuing at $4 per share rather than something higher or getting a better deal somewhere else. I don't know. The management team is working very hard trying to capitalize on the current environment where LNG prices are very, very high. So maybe they'll get something even better than this. But just in this base case scenario, I consider base case, those are pretty high cash flow numbers compared to the current share price. And so we could see if they actually are able to line up the financing and this, Driftwood happens and they get their positive FID, even for phase one, the stock could be worth quite a lot more. And the other thing to really consider when you're thinking about, valuing Tellurian is that sort of even further upside that you have for the future phases, right? Because everything we've talked about so far is just phase one. The future phases of Tellurian have an even lower cost per MTPA per million tons per year that they can produce, because presumably because there's some portion of the site and everything that they can just that is already there. They don't need to rebuild, and they're just extending it, right? And so when you look at these, the profit margins are going to be even higher on these additional phases. And so you kind of, if you're valuing Tellurian, I think it's useful to look at phase one concretely and sort of derive a base value from that, and then view the rest of this as sort of a call option on even these future phases that could be even more profitable when you consider the cost per ton of LNG. So that is my model on the cash flows for Tellurian phase one. Feel free to let me know in the comments what you thought. If you think I got something wrong, or if you model it differently, I'd be really, really curious on this. I am most certainly, again, repeating it, not an expert. This is just how I am looking at it, how I'm thinking about it. So thank you for watching today, and I hope you learned something. I hope it was useful to you, and have a good one.